Charlie, how should financial advisors incorporate real estate credit into their client portfolios?
Greg, real estate credit is probably the largest asset class that most retail investors don't currently have exposure to. This is a $6 trillion asset class, making it the fourth largest fixed income asset class in the US and 50% larger than the municipal bond market. So we're seeing an increased number of financial advisors look at it because there's been innovation, new products are making it more widely available, and very low correlations to other asset classes are helping optimize portfolios.
Can you talk a little bit more about how it plays along with other fixed income products in the fixed income part of a client allocation?
Sure. Real estate credit is ultimately a downside protected income-oriented strategy, historically in the high single-digit income return profile. So clients are generally investing in real estate credit because there's effectively no to low correlation between real estate credit and traditional fixed income, and candidly, low correlation to other alternatives, 0.2 to private credit, 0.3 to real estate equity.
Well, we know what drives the fixed income market. What drives the real estate credit market?
Yeah, right now we're seeing a significant shift in the composition of the real estate credit market. We talked about the size at $6 trillion, but you're seeing the long dominant participant in the industry. Over 50% of loans historically have been originated by banks. Banks are now roughly a third of the market, and that's creating a significant opportunity for alternative lenders to step in, lend at greater scale, but also move up the risk-return spectrum.
And how are you watching the Fed, and what are your Fed expectations? Because it will affect, and their decisions will affect the real estate credit market.
You know, what I think people aren't talking about today is that real estate transaction volumes still haven't recovered from the downturn that the real estate industry has been through. Transaction volumes are 26% lower than they were during the pre-COVID period. And on a long-run basis, you see a strong correlation between interest rates and real estate transaction volumes. So we're actually anticipating a significant uptick in real estate transaction volumes, which will directly correlate to more opportunity for real estate lenders and potentially wider spreads going forward.
Can you just touch on liquidity? Because people can buy REITs and they can buy and sell them on the public market. But when you start talking about things like real estate credit, people get a little bit wary.
Sure. There's a lot of conversation about liquidity in the context of private markets broadly, whether it's BDCs, private equity, real estate equity in a non-traded REIT wrapper, or real estate credit. So this should be viewed as a semi-liquid or non-liquid portion of a portfolio and belongs in a broadly diversified portfolio. But the advantage is much lower volatility than what we would see in more liquid asset classes.
And then finally, so what are the common mistakes that advisors make when they're adding real estate credit to portfolios? And how does Invesco, for example, make sure that when it talks to advisors, they don't make those mistakes?
Sure. Well, I think a common mistake many people make is greed. And real estate credit should be a sleep well at night, downside protected portion of a portfolio. So we see mistakes being made when people are seeking excess yield in this space. We take what we call a credit over yield approach to the business. And I would encourage financial advisors and their clients really to look at the longer term track record of their managers and ensure that they're investing with managers who have a strong credit discipline.
All right. Well, thanks for coming on talking about it.
Yeah. Thank you, Greg.